Navigating real estate during economic downturns requires a deep understanding of the dynamics at play during such times. Real estate dynamics during economic downturns refer to the fluctuating factors that influence the real estate market when the economy is experiencing negative growth, high unemployment, and reduced consumer spending. These factors include changes in property values, shifts in buyer and seller behavior, alterations in lending practices, and policy adjustments made by governments to stabilize the market. Understanding these dynamics is crucial for investors, homeowners, and policymakers alike because they inform decision-making processes and strategies, which can significantly impact financial outcomes and market stability. One example of how economic downturns impact real estate is the Great Recession of 2008, during which housing prices plummeted, leaving many homeowners with negative equity. This led to a surge in foreclosures and significant losses for stakeholders involved. Another more recent example, albeit less severe, is the COVID-19 pandemic-related downturn in 2020, which saw initial market stagnation and a re-evaluation of urban living as people sought more space in suburban and rural areas due to remote work trends. Opinions supporting the focus on real estate dynamics during economic downturns underscore the importance of adaptive strategies. Many experts advocate for a keen analysis of market trends and government interventions, which can present opportunities for savvy investors willing to navigate the uncertain landscape. They suggest that downturns can be a time to acquire undervalued assets, thus maximizing long-term gains. However, challenges and controversies do exist. Critics argue that excessive focus on real estate as an investment vehicle during downturns can detract from its primary function as housing. Additionally, there are concerns about speculative bubbles that can arise from market manipulation or over-leveraging, potentially leading to more severe market corrections. Alternative viewpoints advocate for a more conservative approach, emphasizing stability and affordability over speculative gains. The dynamics of real estate during economic downturns are deeply interconnected with other aspects of the larger economic climate. For instance, changes in interest rates as a response to economic pressures directly influence mortgage accessibility and housing affordability. Additionally, consumer confidence, influenced by employment rates and inflation, can shape the demand for real estate. Understanding these dynamics empowers stakeholders to make informed decisions, whether it's for investment, buying a home, or crafting policy responses. Thus, navigating real estate during economic downturns requires a holistic understanding of economic indicators and their ripple effects on the market. Identifying opportunities in challenging markets refers to the strategic approach of recognizing and capitalizing on potential investments or developments within the real estate sector during periods of economic downturn. This concept is pivotal because, despite the inherent difficulties that accompany economic hardships, downturns often present unique investment possibilities. Asset prices can decline, leading to more affordable entries for investors. Those who recognize and act on these opportunities can secure valuable properties at reduced costs, setting themselves up for significant gains when the market rebounds. For instance, during the 2008 financial crisis, some investors identified undervalued properties in hard-hit areas like Florida and Nevada. By purchasing these properties at low prices, they were positioned advantageously once the real estate market began its slow recovery. Another example is in commercial real estate, such as buying retail spaces when vacancy rates are high and leasing opportunities are low. Once the economy stabilizes, the demand for these spaces can increase, leading to higher rental yields and property values. Supporters of seizing opportunities during downturns often cite the cyclical nature of real estate markets. Economic declines are followed by recoveries, meaning that strategic investments during challenging times can lead to long-term profitability. However, this approach is not without its challenges. Predicting the duration and depth of a downturn is difficult, which means that investments can carry significant risk. Furthermore, financing might be harder to secure during downturns as lenders become more cautious, potentially leading to cash flow issues for investors. There's also a debate about ethical considerations. Some argue that buying distressed properties can contribute to gentrification, displacing existing residents who can no longer afford their neighborhoods. Others contend that investment brings much-needed capital to struggling areas, fostering development and community improvement. In the broader context of navigating real estate during economic downturns, identifying opportunities connects to risk assessment, financing strategies, and market research. Investors who are adept at recognizing potential during economic hardship must also be proficient in evaluating and managing risk to protect their investments. Additionally, understanding the economic indicators that signal a market's potential turnaround can guide timely decision-making. Ultimately, this concept underscores the necessity for investors to remain vigilant and informed, balancing optimism with caution to harness the potential of challenging markets. Evaluating property values and market trends is a crucial process in the realm of real estate, especially during economic downturns. This involves analyzing and determining the worth of real estate assets and understanding the broader market dynamics that influence these valuations. Accurate evaluation helps investors and homeowners make informed decisions about buying, selling, or holding properties, especially when the market is unstable. The significance of evaluating property values and market trends during economic downturns cannot be overstated. During such periods, real estate markets can be volatile, with property prices potentially experiencing sharp declines. Investors must assess whether property values have hit the bottom, enabling them to seize opportunities for acquisition at lower prices. It is also crucial for existing property owners to understand their assets' current value to avoid selling at a loss or to determine the feasibility of refinancing. Let's delve into real-world applications. Take, for instance, the 2008 financial crisis. During this period, savvy investors who closely monitored property values and trends managed to purchase undervalued properties. Similarly, in the early 2020s, during the COVID-19 pandemic, fluctuating market conditions saw regions experiencing unexpected booms or declines. Investors who carefully evaluated these shifts could better navigate the unpredictable terrain. Several experts stress that effective evaluation involves both quantitative and qualitative measures. Quantitatively, it includes analyzing sales data, rental yields, and occupancy rates, while qualitatively, it involves assessing economic indicators, employment rates, and consumer sentiment. These insights collectively form a comprehensive understanding of the market, providing a nuanced view beyond surface-level statistics. However, evaluating property values and market trends is not without its challenges. One significant challenge is the availability and reliability of data. In some regions, especially those with less transparent markets, data may be incomplete or outdated. There can also be controversies among analysts about methodology or interpretations of the data. Moreover, subjective factors like consumer confidence can rapidly shift, impacting market trends more unpredictably. In relation to the broader topic of navigating real estate during economic downturns, assessing property values and market trends connects directly to other aspects such as risk management and investment strategies. Navigating these assessments effectively empowers investors to make better decisions, minimizing risks, and maximizing opportunities in economically turbulent times. Ultimately, a deep comprehension of these evaluations equips stakeholders with the foresight needed to thrive amid adversity. Navigating real estate during economic downturns requires innovative approaches, particularly in financing. Financing strategies in a recessed economy refers to the specialized tactics employed to secure funding for real estate ventures when the economy is experiencing a downturn. During such times, traditional financing through banks and lending institutions can become more challenging due to tighter lending standards and higher interest rates. This makes it essential for investors and home buyers to explore alternative financing strategies to remain viable and competitive in the market. This concept is significant because securing financing is often the largest hurdle in real estate transactions, especially during economic recessions when uncertainty looms. Innovative financing strategies can enable investors to capitalize on lower property prices and potentially higher future returns. Additionally, these strategies can help maintain liquidity and ensure the continuation of real estate projects that might otherwise stall due to funding scarcity. One example is seller financing, where the property seller offers a loan to the buyer, bypassing traditional banks. This can be particularly useful when banks are hesitant to lend, allowing both parties to negotiate terms that work for them. Another example is the use of hard money loans, which come from private lenders willing to overlook the stringent criteria banks impose. These are short-term loans secured against real estate and can be an effective bridge in a tight credit situation. Proponents of these alternative financing strategies argue they provide much-needed flexibility and opportunity in a restrictive fiscal environment. They allow investors to act swiftly and take advantage of market conditions that are not as favorable to those relying solely on traditional funding sources. However, these strategies are not without their challenges. Seller financing requires a level of trust between seller and buyer that may not always be present, and hard money loans often come with higher interest rates, increasing the financial burden on the borrower. Critics also point out that these alternative avenues might encourage higher risk-taking without the regulatory oversight typical of conventional loans, potentially leading to financial strain for inexperienced investors. Financing strategies in a recessed economy inherently connect to wider real estate opportunities and risk management. They influence investor confidence and market fluidity by providing pathways to navigate financial constraints. Understanding and implementing these strategies effectively can mean the difference between capitalizing on a downturn and struggling against the prevailing economic tide.